How classic to have a rally all of Friday's session only to have Moody's come out with a credit downgrade right after the bell rang. So let's take an objective look at the data points to see if this is truly what it will take for the market to snap back to reality, or if, whoop, there goes gravity and we continue in the upward direction here. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stick around until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we certainly have a solid green-bodied bar. A little bit of a lower wick would just imply that the buyers stepped up near the lows of the weekly range, but you can also see that we've closed incredibly strong near the highs of the weekly range. So structurally, the buyers are in control. And let's not get it twisted. Obviously, the preceding weekly bar was far stronger in terms of candle size, but nonetheless, the close up here does strike me as substantial. In terms of location on the bar-to-bar count, we do have a very substantial higher low as well as a higher high. So buyers go 2 for 2, both structure and location this week. But it's better than that because if we're thinking about weekly trend, a couple of things have taken place here. We have finally produced a weekly higher high. So the trend is starting to shift back in the upward direction. Ideally, some sort of pullback that offers a higher low, then gives a better entry point and cements this trend because as of right now, we only have one component. We have the higher high, but we are coming from a lower low. In terms of recapturing levels, I do also really like the fact that there was no rejection off of the retest of the double top neckline breakdown. Remember that on the first test, that's where we were looking for a weekly lower high. The fact that we had this pretty expansive bar in the upward direction, to put it lightly, and the fact that there was no pullback here on a 100% retracement does strike me as, once again, more of a bullish data point than a bearish data point. You can see that we've firmly pushed away from our weekly 50 SMA. That's the blue moving average on your screen. If we go ahead and throw on some anchored view apps, we've recaptured all of them, even the one from the tippity top of the summertime move. So once again, if there was ever going to be a logical place to pull back from to produce a weekly higher low, this was kind of that area, and the fact that we just blasted right through all of these rejection points, or confluence points, I should say, it clearly did not offer a rejection, does strike me as, again, a change of tone here on the weekly time frame chart. Let's take a look through the lens of some Fibonacci's here, coming in from the all-time high, of course. We want to see if we're back over that 61.8, and what you'll notice is the answer is absolutely. Remember, the more time you spend over a 61.8, over time, the more likely it is that you will see that 100% retracement. We were getting a little bit concerned down here, but with the recapture, it is back on in the cards, so to speak, for a 100% retracement. If we come in from the October low up to the high of the summer move, we have held on to the 38.2, so all good to look at this through the lens of a weekly bull flag perspective. And as we know, the monthly higher low thesis really revolved around this level down here. 416.75 was the number that we were using for quite some time. One last Fibonacci sequence to at least understand is coming from the high down to the low, and Fibonacci's are fractal, right? So just like we talked about from the all-time high to the October low down here, if we can recapture this 61.8, the odds would greatly increase for a 100% retracement to the top of the July move. So I'll be watching out for this level here around 440.25 quite closely. In terms of high volume nodes, let's throw on our study set with the volume profile. And what we'll notice here is that we're coming into the point of control. The highest volume node is still overhead. So if there is going to be a little bit of continuation here in the upward direction, we tag the point of control, is that a logical place for the market to pull back from? I would certainly argue yes. And now on any subsequent pullbacks, if we're just looking at this objectively, notice that there's a high volume node here, and technically the point of control is there. In a picture perfect world, a pullback that looks like this and continues is about as shallow as it could potentially get. If we'd see a deeper pullback, what would the volume profile suggest? We really don't want to see much lower than roughly 430. And does that make sense on the daily? Let's take a look now. Let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is roughly 447.08, and that's clearly a higher high. If we're contained by the lower bound, the number is 434.15, producing equal lows to where we traded last week. So expected move here does strike me as being slightly more bullish than bearish, offering a continuation of this as a daily trend reversal. So speaking of daily trend, yes, I would argue because we have finally produced a higher high, this is no longer longer a counter trend move in the context of a downtrend. We have certainly broken to a higher high, and now once again, just like the weekly chart, if we pull back and find a firm higher low, things are sort of ready to rock in the upward direction. You could make the argument that we did actually flip into an hourly downtrend here, and thus this is a daily higher low. And what I really find interesting about that is it's a hold of our daily 50 SMA as well as our gap from over here Friday of 2 weeks ago. So starting to look much more firm, like an uptrend, no longer once again a counter trend move. So going forward, we will probably have more of a bullish bias here as opposed to a bearish one. From a pattern perspective, if you want to think about this as a classic bull flag, of course we've broken out of that into the Friday session of last week. If we do get continuation, the origin of a daily trend reversal, remember that this is a daily double top here. This is the origin of the breakdown that offered a lower low. It's also where the FOMC cycle from September occurred from. So overhead target here would be around 443.25 up to 444.50. Treat that as a little bit of a zone. Beyond that, you're looking at the lower portion of your double top here, the right shoulder, if you will. That's going to be around 447.50 to 448.50. Again, treat that as a little bit of a zone, and it's in alignment with the upper bound of this week's expected move. If we do start to pull back more aggressively, obviously the most bullish thing that could happen here, we'll talk about it on the hourly, is a higher low that's offered over 437.35, the breakout area of this as a balance. But remember, on the weekly chart, we had just described the high volume node at 430. What I would love to see is a pullback that closes the first gap, then comes and supports off of that. It would be your weekly high volume node, and the fact that we could fill one gap, but not the gap underneath us, would be a bullish indication. We're coming into repair structure here, but it's not that the sellers are so strong, we're getting more of a deeper retracement of the overall move. So speaking of, let's take a look at our Fibonacci's from the low of the sequence all the way up to the tippity top of what we've just got. Notice that your 38.2 would certainly be respected if we go for a gap fill reversal off of the first gap underneath us, and that gap closes at 431 as we just discussed. If we go ahead and throw on our anchored VWAP band, just remember that this is anchored to all the major inflection points after the October low of 2022. We've poked over that, and this really shouldn't come as much of a surprise considering what we just saw on the weekly time frame chart as well. But nonetheless, just another illustration that the more time we can spend over this band, also building the case for a higher low retest to hold over 437.35, the more bullish this chart becomes. Remember that in last week's episode, we really were discussing this as a weekly inverted head and shoulders with the break to a higher high. It's not that a higher low pullback can't unfold now, but it's less likely that it's going to be really a battle on that pullback. The fact that we're now pulling back from a higher high is definitely more of a bullish data point as we move forward trying to navigate the monthly higher low thesis and thus a weekly trend reversal, right? The last thing to sort of show here is taking out, let's go to the trend line set here, and we'll just clean up those studies so it's a little easier on the eyes. How about that? There we go. What you'll notice is that we've broken our secondary trend line and we are coming into our primary trend line. So is it logical that after breaking to a higher high, we could afford a higher low pullback? To me, the answer is absolutely. Do not be afraid if the market starts to pull back because of the bullish improvements, specifically from a trend perspective. This big break to a higher high is extremely important. It wouldn't be unreasonable to pull back and look for a higher low. Speaking of pullbacks, obviously on Thursday when there was the sour 30-year bond auction, it stopped the hourly uptrend. Speaking of, let's just go down to the hourly now, right? It stopped the hourly uptrend and didn't see any follow through in the downward direction. So in terms of the trend, it's clearly up. Again, here's your higher high. If we're just thinking about trend, lows, higher lows, so on and so forth. But look at specifically the interaction of Thursday. We open on a gap up higher high. We close the gap, form an intraday lower high, and then break from here to a lower low. Let's get a little bit tighter on this so it's front and center on the screen. Nobody's struggling to see this, right? There's your pullback, there's your lower high from here to here, and there's your lower low. Not only from here to here, but also from here to here, right? So we're definitely in a short-term hourly downtrend there. The fact that Friday opens where there's a clear opportunity for, yet again, another lower high, either underneath this level here at 435.75 or even here, because you could still technically get this, right? The fact that we blast right through that into Friday's close, again, another really strong indication that the sellers are simply nowhere to be found here. If we go ahead and throw on the anchored VWAPs from an intraday perspective, what else do we see here from a confluence perspective? We're over all of them. And again, speaks to bullish odds here. But if we do pull back slowly over the course of this week, let's say Monday opens up and starts to trade sideways, this is slowly going to curl higher. Your first line of defense is the retest over the top of the range here at 437.35. That's that daily, very, very nuanced higher low pullback we were just discussing that keeps the buyers in control outside of what you could consider daily bull flag consolidation, right? So that's the first level to really, really be mindful of. If the sellers are going to come in with a vengeance, what you want to see is this to really turn into a look above and fail. Your first indication would be a lower high underneath 437.35, but then more importantly, some sort of breakdown here. If we produce a lower high underneath the entirety of the range, that would be this segment right here. That's where a deeper pullback is definitely in the cards. Remember, we talked about 431. That gap fill is definitely there, but the lower high underneath, I would certainly start to become more concerned. Remember, from a weekly perspective, our line in the sand, it's quite dim down here, but it's technically at 421.25. So overall, the name of the game, I think we're quite clear on situations. Pullbacks here, start to look for buyers to step up. First line of defense, 437.35. Upper targets, we talked about on the daily at 444.50, down towards 443.25. Treat it as a zone. Anything beyond that, 448.50, 447.50, a dollar zone up there. And as we just described, first lower high underneath that level. Shorts can trade from here down to the top of the gap and then possibly lower highs that keep us in this range to close the gap at 431. And then if you notice that we come in, so look above and fail, right? Lower high here, but then we pop back out of the range. That's all you're getting for a daily pullback. And I would likely say that the daily 50 SMA, the blue moving average on the screen here, is trying to hold up on a retest, right? So any sort of this, then you're back here trading in the upward direction. You get some sort of hourly inverted head and shoulders. The place where the sellers really gain their edge, as we described just a moment ago, just to sort of put it on the screen one more time, is something that looks like that. If this takes place, a lower high underneath 433, we would certainly change our tone and say that we're searching for a deeper daily pullback. But as of right now, as we've already described, not many of the trend and literal price data points suggest that the bears are in control. But should we be overly aggressive to the long side? Let's take a look at the internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner, but for the most part, what you'll notice is that internals were bearish for the majority of the week. You see substantial outflows Monday, Tuesday, Wednesday, Thursday. The advanced decline line is under the zero line Monday, Tuesday, Wednesday, and Thursday, you can see the aggressive breakdown when the bond auction goes sour in the 30-year. Again, that's not at 1 o'clock, it's at 1:01 p.m. Eastern time. Of course, same thing here in the cumulative tick. It really accelerates to the downside after that bond auction does not go to plan. Now, it's not to take away from the buyers, certainly a strong cumulative build to the upside on Friday, but I do have some concerns. Look at the notable, if I just zoom in on the Friday session, right? Here's the high into the close. Look at the advanced decline line, right? Certainly a substantial pullback, and yes, we do make a higher high into the close, but is it nearly as severe as price down here? Certainly doesn't seem so. From a volume flow perspective as well, we had decent inflows, but did we get up and over positive 300 million? No, we did not. So, not to detract again from the price action over here, but it becomes incredibly difficult to buy into a higher high move like this, chasing the higher highs with internals that are not overly supportive of a bullish market. So at the end of the day, the bottom line here is that pullbacks are great. Pullbacks, of course, offer some sort of tighter risk reward entry. I'd love to see this type of setup here for an hourly double bottom, reverse the trend, daily pullback is achieved, and then we continue in the upward direction. I would really have a lot of faith in this if, as we're starting to build out some potential reversal pattern here, the internals did not look like what you see here and were the exact opposite. Mild inflows, mild inflows, mild inflows, really more so on the bullish side of the market. If we're going to start trading more aggressive downside, so say that we do get the situation that looks sort of like this, I would want to see these internals confirm with more looks that do look like this, and this being a one-off fluke from the Friday session. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, let's take a look at Thursday and Friday's value area and point of control. Notice that they're directly opposing each other, right? So value on Thursday, point of control on Thursday, certainly lower in the overall profile. With the change of the hourly trend, it seemed as though we were kind of ripe for a pullback. We also had a poor low down here. So on Friday, opening above that poor low, the idea was, let's see if we can take that poor low out to repair it and also offer some sort of lower high from a daily bar-to-bar perspective. Obviously, we can see what happened here, and clearly Friday's value is right up towards the top of the profile, as is the point of control into the close, and we have an extremely thin structure profile. This, of course, is always in reference to a trend day, but it also illustrates a little bit of single prints right through here. I would be highly attentive early on next week to what happens at 44.05. You could use 4,400 if you like nice round numbers. That would be half back as well, but technically you have a string of single prints that begin at 44.05. If any pullbacks hold up over that, then it's clearly the buyers flexing their muscle saying, hey, we're in total control of this market. If you notice that we fall through the single prints and produce a lower high underneath 44.05, the breakdown would be underneath 43.94, and then you're looking for more of a drawdown for a daily pullback to resume. The reason that the 43.94 level is going to be so important, I really want you to have this on your charts if you're trading ES futures, is that this is directly the value area high of the Thursday session. So this is a mechanical level. This is an area that the market, short-term traders, right, are going to be paying very, very close attention to 43.94. If we're above 43.94, you'd be neutral through here. If we're over 44.05, definitely more so of a bullish edge, but underneath that level, I think that we get a deeper pullback out of this market. Changing gears to the QQQ weekly time frame chart, what do we see here from a candle structure and location point of view? Just like the S&P, solid green-bodied bar, even less of a lower wick on the QQQ, certainly closing at the highs of the weekly range. Structure goes to our buyers. Bar-to-bar count, certainly a substantial higher low as well as a higher high. 2 for 2 for our buyers this week. If we're thinking about trend, obviously we have a clean break of our resistance trend line here. We have certainly broken for a horizontal higher high, and we also know that on the QQQ weekly, we've been tracking this as more so a balance range. Remember that we never closed underneath in this first interaction at the bottom over here. This was your first look below and fail, but this is seemingly a much stronger look below and fail, not only because more shorts got trapped under the breakdown point here, but I mean, clearly the bars speak for themselves. The momentum, the size of those bars in the upward direction, it would certainly seem much more likely that we have the opportunity to truly complete the move, which on a look below and fail is always targeting the opposing end of the weekly balance. So the highs up here closer to 385 will be the intended weekly target if we are looking for continuation. If we do get some sort of pullback, obviously the name of the game is to produce a higher low inside of the overall range at this point in time. Let's continue along and take a look through our supporting evidence studies on the weekly time frame chart. So anchored VWAPs, we've recaptured all of them. Same song and dance as to what we were describing over on the S&P. If we scrunch the chart out, obviously coming from your all-time high to the October low of 2022, there is your hold of the 61.8, a little bit more firm over here in the QQQ. So once again, odds continue to increase for the 100% retracement over there. If we come in from the October low to the summer high, certainly well above the 38.2, never even came in for a test down here. That does strike me as a bullish indication. And coming in from the high down to the low, obviously we are well above our 61.8, a little bit more bullish than the S&P from that particular perspective. Let's go ahead and throw on our high volume nodes and see what's going on from the volume perspective. Scrunching this up a little bit, what you'll notice is that we've pushed away from our point of control. Again, a little bit of relative strength as compared to our S&P 500. So what's the name of the game from the volume point of control perspective? Any higher lows above that level are also incredibly constructive. That level is at 360. Let's go 365. Nice round numbers up here in our penthouse. Concerns would definitely increase if we start trading underneath 354, and lo and behold, 354, 352 is the bottom of the overall weekly balance. If we get down here, concerns increase. Higher lows above here are incredibly bullish. That's over your point of control, and obviously, as we discussed, the target would be the top of the weekly balance. QQQ daily chart, let's take a look at the expected move. Obviously, we are projecting some sort of higher high. The upper bound is at 385.82, and the lower bound is an equal high right down here around 370.94. So expected move very similar to the S&P, bullish, maybe slightly neutral with the indication of an equal low, but obviously buyers are in control here because from a trend perspective, we did break to a brand new higher high. This was a 3-day balance. We've broken out of that balance with a very powerful bar on Friday session. However, we have similar similar concerns as to what we described over on the S&P. From a Fibonacci perspective, let's come in from the low of the move and just gauge where the 38.2 is. It's very close to the Friday low of the gap up from 2 weeks ago now, and that area is going to be around that 364, which, as we know, is the volume point of control that we just looked at on the weekly, but also your daily 50 SMA. So to me, that would be a major line in the sand if there is going to be a more severe pullback, some sort of lower high situation here on the hourly, underneath the bottom of the 3-day balance from here. The bottom is 370, by the way, but a lower high underneath, this starts to become interesting for a stronger daily pullback. Now, if we look at the expected move for this week, that would certainly be well extended through the lower bound of the expected move, but just remember, the market's not really been getting volatility right, at least with the end of week, I should say, push out of the NASDAQ breaking up and out of the expected move of last week. Let's go ahead and take a look through the lens of our anchored view apps to all of the bottoms. Again, this should really not come as much of a surprise considering the weekly and what we just covered over the top of the anchored view app section. So if there is a pullback, again, what does this align with? Very close to, or the top of the anchored view app band would be quite close to the volume point of control, your daily 50 SMA, as well as that gap fill reversal from the Friday session of last week. Those numbers, once again, are at 364.50. The gap begins, the gap closes at 363.50. Let's take a look through the lens of our alternate set with our trend channel. We've broken up and out of that. We illustrated that on the weekly time frame chart. And once again, if the weekly is going to make the full look below and fail rotation, the target should be up here closer to the top of the overall range. Let's go back to the clean drawing set, and you can see those upper targets here. If we do start reaching for continuation, we have 380.50, 384.25, and then the top of the summer move is at 387.25. Let's not discount anything considering what's been going on here with this market making a near vertical move. Let's jump on down to the hourly time frame chart. What I do want to point out here is that we never actually flipped into an hourly downtrend on that Thursday session, right? And the reason being is that we actually broke to a higher high before making your lower low, right? So because we have the higher high, this is not technically an hourly downtrend. It's just balance in this as a range. And we, of course, broke to a higher high into the end of Friday's session. So, and then like to boot, just to add on to, again, the strength of the buyers here, look at the inverted hammer from the first hourly bar of the Friday session, starting to reject the top of that balance, making this feel like look below and fail was going to stay contained in the range. Absolutely not. We, of course, know that we broke right through that 373.50 and saw that lift in the upward direction. So let's throw on the anchored view apps. We know where our Fibonacci pullbacks are, but let's do this. Let's take a look at what's going on here. We can do a couple of things. First and foremost, let's actually bump this forward to the breakout of the Tuesday session of last week. So let's go ahead and edit this up to the 7th. And what you'll notice there is that this is going to start to provide confluence at the top of this as a balance range. So 373.50 is the same pullback as your S&P over the top of its range, right? Buyers looking to step up here on some sort of hourly high or low. If we fall back down into the range, you guys know the deal. As we described, some sort of move through the range with a lower high underneath 370 starts to make the daily pullback around this zone, 364.50, 363.50, become much more attractive. When and if we achieve this on a pullback, as you know, we're looking for an hourly trend reversal, double bottom. We described it as a higher low double bottom over on the S&P, right? But the same thing sort of stands. Double bottom, inverted head and shoulders down here, something that would suggest an hourly trend reversal from a pullback, sort of downtrend on the hourly, right? If the hourly reverses here, this is now your daily high or low, right? So that's kind of how that sequencing starts to unfold here on the QQQ hourly. Let's jump into the market internals for the NASDAQ. You can see a similar picture where there's clear weakness earlier on in the week. We did not have anything substantial from a volume flow perspective on the Friday session. Even look at the advanced decline line, right? Could hardly even make an equal high into the close. Really struggled to make that move all the way on the retracement there. Never mind getting up into trend higher zone. Look at the cumulative build as well out of the tick. It was really more mild out of the NASDAQ, which is kind of interesting to me because the NASDAQ, the tech sector, is really what drove the rally higher out of the S&P in the first place. So if we're not really all that trustworthy of just buying higher highs here, I still think that the primary idea for this market is searching for higher low pullbacks. Let's move along and take a look at the market profile for the NASDAQ, and it's the same old song and dance. Notice how on Thursday, actually slightly different. Friday is very similar, but Thursday is slightly different. Point of control value area is certainly higher on the Thursday session. We still do have that poor low over here, but on Friday, we followed up once again with value area higher, point of control higher, very much so more sporadic little intermingled single prints over here. I wouldn't really look at it through that lens on the NQ, and instead I would say that your halfback, which is the purple line on my market profile, is the level you want to use just because it's also Thursday's high of day. If we can stay over that halfback, which I'll give you the number here, is going to be at 15,455, any pullbacks over that are the most ideal bullish situation. Breaking down underneath, you know the deal, we're back in the balance range from the hourly chart. Let's go back on over to Thinkorswim. Back in the balance of the hourly chart, should target the bottom end of that range, which is here, 370 out of your QQQ. If we're looking at the NQ futures, the bottom of that range would be here, closer to 15.2. IWM Russell 2000 and the small caps on the weekly time frame chart prepare to be disappointed because this is nothing like any of the other indexes that we were just looking at. Clearly, a mostly solid red-bodied bar here, a little bit of a lower wick, nonetheless closing fairly weak in the lower third of the overall range. I would say that the sellers, the bears, are in control from a structural perspective. If we think about location on the bar-to-bar count, we did produce a higher low but also a lower high, so a very classic inside bar. And if we're thinking about the overall trend sequence of the IWM Russell 2000 on the weekly time frame, highs, lower highs, this is still just a lower high. So this has not done anything to, quote, reverse the curse and change the trend in the upward direction. As a matter of fact, quite the contrary. If we're actually, let's just take this way out. There we go. Here comes the danger, right? If you take out a trend line and do something like this, we've not only broken that trend line, but this last week's worth of trade is a lower high on the retest of that trend line. If we go ahead and throw on the anchored view apps for our IWM small caps, we're underneath all of them. This should really come without surprise. We talked about the pre-sickness high and the sickness low anchored view apps. We're underneath all of it. There's really nothing bullish to say here on the weekly chart from like, oh, maybe we're being slightly constructive in the upper third of the weekly range. It's the exact opposite. It's actually quite bearish in the lower third of the weekly range, rejecting in the upper highs of the last 2 weeks worth of trade the anchored view app from the most recent attempt at the top of the range back over here. If you bring out a Fibonacci, the only place that really makes sense to measure on the weekly is from here to here. We're underneath the 38.2. It's been that way for a while. We're trying to resolve the 50% mark. As we know, if price starts to make a move underneath the 61.8, things become incredibly dangerous for a 100% retracement all the way down to the sickness lows. Can you imagine a broad market ETF trading at the sub $100 price point? It's been a while since we've done that over here in the IWM. Let's go ahead and clear that up and throw on our volume node. What's going on from a volume profile point of view? We are rejecting the point of control, the highest volume node, and look left, a massive low volume void is underneath us. The next major area of support is much closer to 155 on the weekly. Now, as we know, small caps have been the canary in the coal mine, and this again is one of those reasons for the S&P and the NASDAQ why we might not necessarily want to be aggressive trying to buy higher highs. If you can buy a higher low with tight risk reward, that's at least a bit more manageable, but trying to buy higher highs where the small caps are clearly underperforming is, I don't want to call it a recipe for disaster because obviously we've seen it working over the last week or so, but from a risk management perspective, really doesn't sit well with most people who have been around the market for any period of time. Let's take a look at the daily chart. Clearly, again, what is this? This is a downtrend on the daily time frame chart here. We have our lower weekly high clearly illustrated. We are well underneath our daily 50 SMA. The expected move this week is bearish. Lower high from here, and obviously some sort of lower low. 173 is the upper bound, 165.25 is the lower bound. What you'll also notice is that we've already closed the gap from the Friday gap up of 2 weeks ago. So a lot more damage has already been done in terms of a pullback. Now, it does beg the question, if this pullback is coming to an end, can it still remain constructive for a inverted head and shoulders here on the weekly, and then we'll look for a trend reversal when and if we could take out some sort of neckline trend line? That is possible, and I do like what's going on with the Friday session. Technically speaking, we undercut the low of Thursday by just a little bit, and then we closed right back up at that 169 level. So if we could hold on to this, if we could see a constructive move up here on the daily chart starting to push towards the upper edge of the expected move, anything that then pulls back and can continue to find higher low acceptance over 169, I would start to look at this, okay, maybe there's a small benefit of the doubt, but unless that actually happens, we have to take it at face value. So just closing at 169 169 is not enough. If we stay down here, this is just bearish consolidation on something like the hourly. Speaking of, let's just go there now. If we take a look at the hourly, I mean, clearly in a downtrend with highs, lower, I mean, just the illustration is night and day between the S&P and the NASDAQ and the small caps here. So as long as this can kind of just put in lower highs and continue to chop around, I would just argue anything that remains under 171, bears are just building out healthy bear flag consolidation from an hourly perspective. If we can break over 171 to produce a higher high, right, something that does this, that's why 171 is the key break, then pullbacks that hold 169 are constructive, as we were just discussing on the daily time frame chart, because that would produce your daily high or low. And as you could start to imagine, let's draw on the break of 171 first, right? As you could start to imagine, this produces an hourly trend reversal. Lows, higher lows, there's your high, higher high. So you get the point of what we're getting at here on IWM. If we go ahead and take out some fibs, let's just begin from the top and take a look at the pullback. Once again, this would sort of reiterate that your 171 is a key area. It's very close to the 38.2. It's not precise, but close enough for, what do they say? Horseshoes and hand grenades, right? Next up, you take a look at the 38.2 from here, also very similar to your 171. So I'd really prefer to see if we're going to be constructive on small caps. If there is going to be a move that is sustained and helps support the broad market, you got to get up and over 171, or at minimum, keep spending more time over 169. Anything underneath, and I think that you can just kind of kiss the Russell 2000 and small caps goodbye. Let's take a look at the internals for the Russell, and you can clearly see not even bullish inflows on that Friday session. So this is not helping the bullish case. Again, clear hourly downtrend. Let's not forget that. Until it actually changes, bears are completely in the driver's seat. I mean, look at the internals here. A little bit of a squeeze, right? That would sort of indicate squeeze to me here out of the cumulative build, the fact that it just rips to the upside and goes flat into the close. If it was more of a gradual build throughout the entire course of the day, I would say there's maybe a chance that stronger new money buyers are getting involved, but this is, that's a dead giveaway for short squeeze when your cumulative build looks like a 90-degree flat top plateau. Let's jump on over and take a look at the market profile for the small caps, and you'll notice that, we did get the point of control and value lower on Thursday. On Friday, it's slightly higher. You can see that small undercut of the low from here, so we did repair the, quote, lack of material excess. If you zoom in on Friday's session, you can kind of see how we did put in enough single prints at the lows. So there's an opportunity to remain constructive here, but it does need to show some major signs of improvement. Bearish edge overall, but if it is going to improve, it's kind of do or die. This is your chance at a pullback. You need to make something happen if you are constructive or bullish on small caps. Let's take a look one step further behind the curtain at the weekly performance of our S&P sectors. Leading the pack this week is none other than the XLK tech sector, heaviest weight risk on sector, up 4.38%. It's followed by communications, also a risk on sector, up 1.3%. Industrials, consumer discretionary also stands out as a risk on style sector. At the bottom of the barrel, we see the XLE energy sector really getting beat up, down 4.53%. As we know, it's not technically D for defensive, but it is extremely lightweight, so it's not going to impact the S&P as much as, say, seeing the XLK down 4.5%. XLU definitely is lightweight as well as D for defensive, down roughly 2.66%. Real estate lightweight, materials lightweight, healthcare D for defensive in the overall lineup. So posture in the sectors does strike me as being more bullish than bearish, looking for either continuation or on any pullbacks, as long as we remain in this bullish risk on posture, looking to buy those pullbacks, right? This is really not all that bad of an idea if the sectors remain in this sort of standing. Let's take a look at the XLK tech sector and see what's going on from a structural perspective. Breaking, so look below and fail, not only to the top of the range, but breaking for a major higher high into the end of the week. That Friday session is incredible, even taking out the flat top from back here. So ideally, in a picture perfect world, you get a higher low that stays above the top of the balance. That would be 175.70. Even if we do pull back, you're looking at 172.75. That's a really mild pullback, still searching for a higher low over your prior weekly inflection point. I mean, not for nothing, but this is long ago broken our weekly resistance trend line, right? Definitely a bullish look here out of the tech sector. Next up, communications. Same song and dance. There's your look below and fail. There is your higher high over the top of the balance. It couldn't quite clear these highs from in the past, but again, breaking from this as a little balance range into the end of last week does strike me that, hey, we could see day two follow through in the upward direction that would be bullish for the broad market, noting that communications are definitely a risk on style sector. Here's industrials, roughly 8% of the S&P, trying for some sort of really really sloppy inverted head and shoulders. Not that it matters too much. Remember, the lighter-ish weight sectors, this is 8%, it's not nothing, but they're definitely more meaningful when we break to a new swing high, swing low. So if we could take out 103.60, it would help the bullish case. Here's the XLY for consumer discretionary, definitely a heavier weight risk-on style sector, still unable to recapture the bottom of this prior inflection point from over here at 163.25. In a picture-perfect world, this would have been trading up here, closer to this gap, more so in unison with its XLK counterpart, if you will. So a little bit more work needs to be done over here. Maybe the XLY is the sector that keeps us honest. I do love the perfect gap fill reversal from the Thursday and Friday interaction. We closed the gap from the Friday of 2 weeks ago, immediately reverse and close stronger as opposed to weaker in the overall weekly range. Let's take a look at the XLP consumer staples. There we are. Putting in a balance area, if it breaks, again, it's definitely going to be helpful for the broad market, but because it's not actually leading the broad market in the upward direction, I'm not overly concerned from a leadership perspective. Remember, consumer staples are technically a risk-off style sector. Here's the XLF for financials, getting some balance around the big weekly inflection point. Let's not forget the importance of this level straight through here at 33.65. The fact that it's not breaking down aggressively, producing just a weekly equal high and then breaking down all the way to an equal low, that does strike me as slightly constructive. It would be even better if we could exit this as a multi-day range up and over 33.90 on a breakout. Your next target would be the bottom of this overhead supply at 34.60. So watching this quite closely, if financials can start to participate in the upside, I would say that that is likely what can continue the market rally in the upward direction. We've seen that the XLK, it's done its job, right? The XLC, it's done its job. XLY needs to do some work, XLF needs to do some work, and those two sectors alone could continue to push the market in the upward direction. Here's energy taking a beating this week. You can see breaking down underneath this inflection point here. Nothing about the chart does strike me as bullish. So a little bit of a balance down here, but clearly an opportunity for a lower high up against 84.50. Next up, we've got XLU. What's going on here? Definitely a deeper pullback, but weekly higher low. You've got to think constructive on a potential reversal off of 60.10. If that holds up, then okay, not the end of the world. And once again, because it's not leading this market rally, it does strike me as a decent look. Upward pressure, don't forget, is still upward pressure for the market. Here's real estate. Extremely rate sensitive, as we know. Mild pullback. As long as it can hold over this, you're talking about a constructive daily higher low. Ideally, we would spend more time over something like a weekly neckline here at 34.80 to help out the broad market in the upward direction. Here's materials, really lightweight sector, balancing going sideways. You got a gap overhead, gap underneath. I would just be watching, when and if this takes out the top over here. Remember what we were talking about in terms of lighter weight sectors making new swing highs. You really want to be up and over 79.55 for the XLB to be a helping force for the market in the upward direction. Downside, you got to be underneath 74.75 to say, okay, let's think twice about anything on the long side, right? Next up, last but certainly not least, XLV, second heaviest weighted sector by market cap. What's going on here? Certainly D for defensive. Look at the, I would call that a beautiful hammer, right? You technically take out a major low, which had momentum from the Thursday session, and then you close back inside of that Thursday range after breaking and violating a level. So what I would love to see is the XLV start to build this out as a daily higher low, take out the hammer high, and then we're looking for a retracement into 127.50. And you could see that as the bottom of this little balance right here. In a picture perfect world, we trade back to these equal highs and then just start chopping around sideways. Remember, you don't want this aggressively outperforming because it is D for defensive, but being the second heaviest weighted sector, you cannot really afford to have healthcare in an overall downtrend. So would love to see this low hold. If it does not, that would definitely be much more of a red flag for the bull case in the broad market. Let's jump over to the sector ratio grid. If you're not familiar with the screen, check out the video tutorial in the top right hand corner. And my goodness, what a massive shift to risk on in tech here. Look at the break of this flat top. Incredible move in the upward direction. This definitely does strike me as a major risk on indication. The only issue that I see is XLY is not participating, XLF is not really participating, XLC is not really participating. So sure, it's definitely helpful that the tech sector has led this rally to the upside, but we need broader-based participation if we're going to look for a sustained move in the upward direction. The only other thing that's helping the risk-on case is that risk-off is not aggressively outperforming. Look at the XLV, nasty move in the downward direction. XLP is fading, XLU is fading. Even, you could say that real estate to some degree as a hard asset is a little little bit defensive, right? So we're not seeing a risk off rotation, but we do want more broad-based participation than just the tech sector in the upward direction. Let's take a look at the XLK over the SHY. Undoubtedly, this is going to be making a higher high, right? But this is technically a bullish divergence. If you take this straight across, it's a very nuanced higher high, but it is technically there. The fact that we've produced a higher high might suggest that the S&P, could see continuation in the upward direction based on this sort of shift here. If we take a look at the XLK over the XLU, this will be kind of the same old song and dance. There you go. There's your break to a higher high. No surprises there. The one concern, and again, something that's keeping us honest, is something like the XLY over the XLP. If this is the original range set by a low and a high, lows and highs, look above and fail, look below and fail, and now we just find ourselves tangled at the daily 50 SMA. So it's not bearish because we're certainly not trading underneath the range, but it's also not a pure risk-on indication trading up and over the top of this range either. So again, keeping us honest, if a pullback unfolds, we really don't want to see these things deteriorate, but then on any subsequent rallies in the upward direction, a little bit more broad-based participation would give you the confidence to say, okay, we probably want to trust this style rally. Let's move along and take a look at our dollar, the Dixie, if you will. And this is actually indicating it wouldn't be insane for a pullback. If this is a balance range outside of a monthly balance range, right, this is technically a look below and fail. We didn't really see much acceptance from the dollar underneath that 105.65. So if this continues in the upward direction to complete its target, which would be the top of the range, right, that would be this, look below and fail, always targets the top, as we've been discussing, that would be a headwind for the equities market and certainly might suggest some sort of pullback being somewhat imminent. What would confirm that? Well, let's take a look at the gold contract. If we take a look at gold, look at this, right? If this again is a range and this is a failed move up to this equal high back into the range with a lower high and the target is a retest of the support down below, if we go to 1915, of course, that would suggest that the dollar can continue towards the top of the range and once again, maybe a little bit of a headwind for equities down below. Let's move along and take a look at the TNX for our 10-year yield. This is certainly starting to suggest a daily head and shoulders over here, but you have to think of it through the lens of the weekly time frame chart. If the weekly time frame can really produce a reversal off of 43.33, call it 4.3 in the 10-year, right? If we see that rates are holding 4.3, there's nothing suggesting that this is nothing more than just a weekly higher low and then an upswing back to 5%. We know the upper target is roughly 5.3. So I don't think we're out of the woods from a rates perspective, but if we are looking for them to come down, I mean, this is definitely a good start. Something that would be even more confirming for lower rates would be a lower high beneath 4.3 at this point in time. Seems a little bit unlikely considering lots of the posture from what Jerome Powell has been talking about recently, higher for longer. We don't know if we're at sufficiently restrictive rates. The ZT would sort of confirm that as well. This is certainly not suggesting a rate cut, but it's also not suggesting a rate hike, right? If this was breaking out, you get your rate hike. If this was down underneath here, that's your rate cut. Neither of the two as of right now. Let's take a look at the tracker tool. Absolutely, positively, no surprises over on the Fed tracker tool, completely aligning with the inverted ZT as well as with the comments from Jerome Powell himself. Aside from the hot mic slip up where he told a climate protester to, hey, let's just shut the effing door, it's just higher for longer. We're going to continue to ask the question, are we actually at a sufficiently restrictive policy? And that's what this higher for longer is illustrating. The next big thing to at least start talking about, this is not pertinent to this very moment in the market, but what's the pace of rate cuts? As we start moving towards 2024, how fast is the market pricing in cuts? If it starts pricing in really aggressive cuts to like 300 basis points over the span of 1 or 2 months, you better believe the market's pricing in, hey, something's going to break and it's going to cause a big issue with the market, right? The Fed will have to intervene by pulling out their last resort card and saying, hey, we're going to cut rates and we're going to spur some economic activity, right? As of right now, 25 basis points at a time, hanging out there for a month or two, doesn't really seem like an aggressive cutting pace where we're overly concerned yet about the implications for the economy or the market as a whole. But start thinking about that as we move forward. What do we get in the coming weeks worth of trade from a fundamental data perspective? Incredibly important. CPI comes out on Tuesday at 8:30. So we will be live up in the penthouse for the live market reaction, coffee and donuts on me. There's two schools of thought here. First and foremost, you can see the forecasts are for a reduction of inflation for the month of October, right? 3.7 year over year goes to 3.3 0.3, month over month 0.4 to 0.1. The two schools of thought are that this is going to be wildly inaccurate because of number one, medical inflation, right? You always get the October read is scheduled, or you could see that forecast, at least from PwC. I would argue that they're fairly reputable, right? PricewaterhouseCoopers. You'll notice that we get this uptick in the cost of medical services, right? So if that's going to start being priced into the CPI read, remember, it's just annual. This is not update. So if this is any increase from what it was last year, that would be sort of a bad sign for inflation. Now, the counter argument is that rent inflation has been coming down aggressively. If you look at the gray line here, we'll maximize the chart, then I'll go back out so you can see the source. If you look at the gray line, this is coming down aggressively, and this is CPI, obviously, for primary rents and owner's equivalent, So if that's the case, this will actually alleviate some of the inflation. So it's all about that balance between housing costs as well as medical costs. Personally, I'm much more along the, I would marry into the idea that this reduction over here in housing costs would be far more substantial to reduce inflation than an uptick in medical costs. I think the forecast is only, I say that lightly, right? Only 1% higher for medical costs as the contribution for CPI as of right now. If we continue away from our fundamental data, let's talk about earnings. This upcoming week, we have a couple of heavy hitters from the retail perspective, right? Home Depot, it's not truly a retail stock, but from a materials perspective, you definitely get that. As we move into Target, as we move into Walmart, as we move into Ross, as we move into Macy's, this is where your retail spend is going to come out, and we'll learn something about the consumer BJs as well on the Friday session, right? So we'll be watching that quite closely to see if any of these major companies have any indications as to consumer spending. Is it decreasing? Is it stable? Is it increasing even as we head towards the holiday season? So I'll be keeping a very close eye on that. And the last thing I have for a fundamental take here on today's session is looking at our bottom-up EPS for 1 year in the S&P. This chart speaks 1,000 words by just being a picture itself. Look at what's going on here with earnings aggressively being cut, right? The forecast, or it's bottom up. So what's going on with earnings is aggressively declining. That means the only reason the market has rallied over the past little bit here is because of a PE expansion, right? And why do PEs expand? Because rates come down. So the market right now is highly attentive to what's going on with rates. If inflation comes in hotter than the expectations, I would not be surprised to see that act as a catalyst to undo this PE expansion and see a deeper than potentially expected pullback than what we've been talking about in the S&P thus far. With that said, let's jump back on over to the technicals. Let's take a look at the risk appetite for our market, and what you'll notice out of the TLT ratio to the S&P is that we still do not have a break of our resistance trendline. There is no classic flight to safety style trade unfolding, but we need to caveat that with the TLT ratio just going sideways down here. It's no longer really aggressively trending lower. It's very possible that any sort of uptick here could kick off that style mechanism. One thing that's keeping us a little bit more grounded from saying, okay, full-blown flight to safety is what's going on with credit spreads, because TLT acts as the flight to safety mechanism when credit spreads are massively expanding. So here's expansion, here was expansion. Now that this has sort of been undone, if you will, I'm not as concerned with a break there in the TLT. If we take a look at what's going on with bonds in relationship to themselves, in case the TLT is broken, we don't want to use that as a metric. These are moving in constructive directions for a stronger base being put in the S&P, right? It's basically indicating that there's no longer a preference for short-dated immediate bonds because of some uncertain future. So this does speak well and speak in conjunction with some of the constructive risk-on style looks we saw from a sector posture perspective. Let's move along and take a look at the HYG in isolation. This would keep us in the camp of looking for a pullback, though. What you'll notice here is that the HYG has been unable to produce a higher high into the end of the week, whereas the S&P equities down below certainly have. It sort of helped out on the Thursday session, giving us the lower high first, but it still has not produced an equal or higher high compared to earlier on in the week. This is something that I'm certainly carrying forward into the early stages of the coming week's worth of trade. As long as this can stay underneath the trend line, certainly would be more skeptical about trying to buy into the higher highs out of equities, which has been the name of the game in the first place for the entirety of today's video, right? We're always talking about where's that risk reward setup. If this is divergent and we're chasing a higher high, really tough to manage risk up at the top of the S&P move. Let's move along and take a look at the Bitcoin chart, what's going on with the good old BTC continuing its break in the upward direction, not one-to-one with equities down below, but certainly much more of a risk-on style indication for our broad market. What about market breadth? Let's take a look at new highs versus lows. This is interesting because technically we broke to a higher high on this week, but we actually pulled back from a market breadth perspective. Now, I want to give credit where credit is due. We're certainly not sitting down below on these lows anymore, but we did flip to negative and we could not remain over the zero line. So I'm watching that quite closely. You'll also see a similar indication out of the SPX A200R. This is a weekly chart. This is a weekly chart, right? We broke to a weekly higher high. Why is it that we actually pulled back and caused a downtick in the SPX A200R? Shouldn't more companies have been recapturing their daily 200 SMAs? What this would suggest is that the rally was brought to you by, lo and behold, the Magnificent Seven, right? Which is primarily mega cap tech in the first place. Let's move along and take a look at something like the SPX A50R, now on daily time frame charts, just to sort of indicate the time frame here. Notice that we are at the equal high. So this is actually, excuse me, playing a little bit more nicely with what's going on in the S&P, saying, okay, sure, it's the mega cap, it's the Magnificent Seven, but overall, we're remaining somewhat constructive near the 50% mark out of the SPX A50R. Moving along to something like the RSP, what's going on with the equal weight S&P. Mild pullback. I honestly love how this is holding 140. Now, as long as it can hold that, I think that we're in better shape as opposed to worse shape, but it leaves a lot to be desired, right? Certainly, if you take out a trend line and do something like this, we're just rejecting, we're underneath. We want to see a break out of that. Honestly, a move up and over this flat top becomes much more constructive to at least attempt to do battle on the breakdown level of 145.75. So it's not like it's rainbows and butterflies, but it's a good first step trying to get that consolidation, trying to get that price acceptance around 140. What about the QQQE for the equal weight NASDAQ 100? It's the same old song and dance here from an overall perspective, noting that we have just consolidation right on the recapture of this area right here. Because this is just a balance range, I think we'll learn much more as this week unfolds. Do we push out of it or do we break down from it? That would be a fairly big tell for the NASDAQ. Moving along to our Dow Industrials versus the transports. What's going on from a divergence perspective here? The transports are still saying, not yet. Like, hold your horses here. No reason to be overly aggressive. And once again, this would play nicely with the pullback theory that we've been describing for the S&P. Notice how we actually have an equal, if not higher high here, whereas this to this is certainly a major lower high out of transports. Dow theory would suggest that you want to see these things acting in tandem, producing higher highs in the sequence together or lower lows in the sequence together, right? Really, the big lower low first out of transports was what led us to believe that the Dow could continue lower in the first place. So watching that quite closely to note if the transports will be correct again this time sort of says, hey, not yet out of this rally. That's the main point of this one. Let's move along and take a look at some volatility indications. Certainly lower in the VIX. This is healthy for the bull case to be made as long as we can remain around 15 and not really see an aggressive uptick here. And if we take a look at the precursor to upticks, usually the VVIX itself, what's going on from this point of view? Certainly hovering in an acceptable range. Remember that if we're floored way down here towards 75, that's actually complacency zone. And it really leaves the door open for the littlest thing to kick off a volatility event. The fact that we're kind of in the midpoint, I wouldn't even call it midpoint, but maybe lower third of this as an effective range, that does strike me as a healthy place for the market to be trading. We're certainly well underneath that 103 handle. And last but certainly not least from a volatility perspective, what about our VIX futures? Moving into a deeper contango as opposed to a backwardation up here. There's 4 days left on the contract. We'll update that as we approach the Wednesday session. But for the most part, this would be a healthy indication for money managers being willing to allocate capital to the current market environment as opposed to backwardation up above. The 9 versus 30-day VIX agrees, as well as the 1-day VIX over here. Last but not least, one additional chart to share with you because we did not cover it earlier is SMH for the semiconductors. We should have talked about this when we were going through our sectors. It just dawned on me, but here it is. Notice the big break out of a potential weekly double bottom neckline. The more time we can spend over 152.25, the more constructive it is and the more it helps the case for the NASDAQ side of the market to continue in the upward direction. I would still argue if this does pull back, because we're coming from a higher high, you could still find a higher low even if we're underneath 152.25. The line in the sand, of course, has to be here at 143.40. If you've made it to this point in the video, I appreciate you coming out to the show. Do me a favor, hit the thumbs up button, subscribe, all that good stuff, and let's jump right into our core list of companies. Apple is up first on the chopping block. Notice that we had a two-day balance on the Wednesday and Thursday session, breaking out on Friday. This looked extremely similar to the SMH, which we were just looking at, obviously not in the chip space directly, but breaking out over that 180, 150 is the equivalent of your last swing high. Any pullbacks that are above that do strike me as being the most constructive for Apple. If it does pull back deeper than that, I would personally love to see 177.50 hold. Weekly higher low can be found at 174. To me, that's giving back a little bit too much of the overall move in the upward direction, and it's not just a feeling, right? If you take out the Fibonacci's from here to here, you would be breaking down underneath your 61.8. So it's really based on the technicals. That 174 is a line in the sand from that perspective. Here's the hourly time frame chart. What I want to point out is, it's the same thing. I hate to overuse some Aerosmith here, but same old song and dance, higher low over the top of the range, 183.75. You can try to trade that in the upward direction, chasing new money highs. It's difficult, really, really difficult. Upper target's going to be 188.50. Gap close overhead is 190 up to 190.65. We'll update you on Wednesday if we need higher targets than that. The bears really get something going on for that daily deeper pullback with a lower high underneath 181.50. That, of course, is the two-day balance from right here. Staying on an hourly time frame chart, here's Microsoft. We just broke to a brand new all-time high, so we don't even need to look left anymore. We are just looking forward at blue sky territories. Whole and half dollars. Any intraday levels that form are going to be your overhead resistances. Any pullbacks, obviously, top of the range. I will sound like a broken record today. I'll just give you the numbers. Prior level and area to be concerned with is the all-time high at 364.25. Higher lows above, trade in the upward direction. You guys know the deal underneath the bottom of the range here with the lower high at 360.50. You can trade for a deeper daily pullback. Where does the deeper daily pullback want to find support? Ideally, up and over 346.75. Again, thin structure through here, so that pullback could happen sooner rather than later, but one step at a time. This is one of the major contributing factors to the S&P seeing this big break on the Friday session. Microsoft, second heaviest weighted stock in the market cap of the XLK, right? Google, what's going on with Google? Certainly a little bit of a balance up here. Looking for a break of these flat tops. You even started to get that on the Friday session. The reason that I'm more particularly drawn to Google longs is because we still have an earnings gap to close overhead. And if you look at the interaction at the low of Thursday's session, we did technically make a lower low. So the sellers failed down there at the bottom, and we closed for a bullish engulfing bar. Here it is on the hourly time frame chart. You can see that V-shaped recovery. You can see the dance it did on the morning of Friday, straight through the overhead supply. Didn't even think twice about it here, did not think twice about it here, and now we're overhead. So the name of the game is that not only can higher lows happen over the top of the prior balance here, but even if we pull back into the range for what might appear to be a look above and fail, you still have an opportunity for a higher low here at 131. So watching Google as an upside trade, considering the range overhead and the opportunity for multiple higher lows on the hourly. Next up, Amazon. What's going on over here? Same thing. Notice that we have ourselves a balanced range, sort of a break underneath, closing strong at the highs. If we do get follow through, your next target overhead is at 145.50. Anything beyond that is 150. These targets are coming from way off in the past. Let's jump on out to like a 5-year chart just to illustrate. Remember that as the market was breaking down here throughout 2022, the VIX was elevated, right? Which means that the prior ranges are going to be much wider. So you can see that your balance range here that we're concerned about is 150 up to 157.75. If we go to current times, those look like massive targets overhead, but in reality, in the past, that's just where the structure was. So understand that the upper targets here are going to be a little bit lofty if we can see continuation in the upward direction. Obviously, breakdowns under 140.50, start your pullback, and the line in the sand here is 134. Next up, we've got NVDA, obviously involved in the chip space, helping out with the move in the market, the SMH that we were just seeing. You'll notice there's your higher high, gobbling up the upper wick from the inverted hammer from the Thursday session. And we do have earnings. They're still further out. They're on the 21st of November, so keep your wits about you for that one. Daily higher lows, I would want to see over 450, right? Any sort of pullback in there, because if we take out that fib, is it going to marry up perfectly? I mean, come on. The eyeballs are well calibrated today. There is your 38.2. 450 would be a reasonable bull flag consolidation from this perspective. Build out a weekly balance, then get some continuation. Maybe the catalyst, just maybe, is going to be earnings. Maybe earnings will be the catalyst to send it all back down to earth and restore gravity, so to speak. So we shall see, but as of right now, the pattern certainly is bullish, again, breaking to a higher high. Continuing along, Metaverse, what's going on with Zuckerberg and the fantasy land over here? Constructive look. I mean, these incremental higher highs that finally rewarded the longs, to me, that's a great opportunity for them to exit. So providing some Sell side pressure, of course, means a pullback, but if the pullback can remain constructive, if we're not going to get long liquidation just as a liquidation break underneath this 317, remember that we're not interested if Meta starts trading back down into this chop range. Just a reminder, a blast from the past. This is a really, really tricky range to resolve in Meta down here. So I'm not thrilled if we're trading, I don't know, what's the top of that range, sub 310.50, give or take. So I'd really use this 317 as a line in the sand. I don't want to see it underneath that. If it does, we'll take it at face value. We'll go day by day. But as of right now, trying to remain constructive on pullbacks over 317 for some sort of continuation. You can see the upper targets there. Let's move along and take a look at Tesla. What's going on with Mr. Musk's boring company? I know that there's someone in the comments who absolutely hates that, so there you go. Mr. Musk's boring company. If you don't like the commentary, if it's not funny enough for you, go find someone else who provides better dad jokes. But what's going on with Tesla? In all seriousness, you've got to get it up and over 218.50. Friday's hammer is constructive, but the opportunity for a lower high underneath is no good, right? If you just reject that, you get a daily lower high after already producing a daily lower high, and the boring company lives on. It'll become Mr. Musk's rocket ship if we can start to break into this gap overhead to finish up our unfinished business from the earnings gap down. So there's some work to do, primarily revolving around 218.50 as a level. Taking a look at the hourly time frame chart, I was honestly thinking that, okay, we sort of saw look below and fail, look below and fail. We were going to, I was thinking that, okay, now is the time to go. Didn't happen. Obviously, Thursday's breakdown was the nail in the coffin, and Friday did not produce any substantial rallies like some of our other big players in the tech space. So if Tesla is going to remain relatively weak and the market's going to pull back, this is definitely a place where you want to be thinking about potential short trades, but and the level is up against 218.50. So watching that quite closely into the coming weeks worth of trade. Here's Netflix. We're still on an hourly. Let's go to a daily just to understand what's happening here, and we will of course zoom in a little bit. And the earnings gap, yes. Earnings gap from over here is what we have in play overhead. That's over 453, closes at 470.50. Remember, there's plenty of range there. Let there become an hourly uptrend, and then you can start to execute in that area. You are buying the highest high of this overall leg up, and this is all coming from the catalyst of our last earnings cycle, a stronger daily pullback. I would honestly love, let's go down to an hourly. Let's take a look here, right? Very clear flat top, which we broke out over at that 437. A retest of that, undo Friday's move, that's fine, but technically the break is in place. We have strong buyers who have clearly established themselves over 437. Retest there for a higher low, keeps the hourly trend looking quite constructive. There's beautiful confluence with a potential trend line. Retest of the ascending triangle breakout point, flat top breakout point. You get the gist at 437. That is your first line in the sand in Netflix. Anything underneath that, I think that your weekly line in the sand, I know we're jumping time frames here. From an hourly, if you could envision a weekly line in the sand, it's where we got the equal high breakout from, which is at 415.25. Maybe it's a little bit easier to bridge the gap here on the daily, but you just want to see a break, retest, and there you go. There's your weekly high or low. So sure, there's downside room to trade puts, shorts, whatever floats your fancy in there, but your next major stop is at 415.25. So yes, I am aware that on Wednesday, I left you hanging with the 3 additional trade ideas on that video. I'm not going to leave you hanging today, and luckily, one of these ideas is a rinse and repeat. So Boeing is something that I was going to share with you on Wednesday, and it's actually set up even better for this upcoming week's worth of trade. Everybody's favorite pattern around the channel these days is, of course, the inverted head and shoulders, and we have completely normal two-sided back and forth trade happening over here. Organic price discovery, it was oh so lovely, moving in the downward direction. If we take out this neckline, we start to jeopardize some of that really funky structure over here, and I could imagine a move in the upward direction unfolding quite nicely. A first target might potentially be your daily 200 SMA, which is also where we saw a little bit of a stutter step before continuing in the downward direction. So your breakout neckline is at 196.50. Any higher lows want to remain over 188.25. Looking for either consolidation here or just a straight up break to get us there in the first place. Boeing lives on as a trade idea. Next up, we have Pep. What's going on with PepsiCo? The competitor to Mr. Warren Buffett. What do we see over here? I love the hammer that printed on the Friday session, looking underneath the Thursday low, and now we're looking for follow through from this as a little bit of a bull flag. If we look left, breaking back up and over that high is recapturing the origin of the breakdown over here, and our next overhead target would be the lows from in there as a retest. So you're looking at flag, break, retarget up at 173.75. That's the upside move out of Pep. Not interested if we we start to retrade through Friday's low and are in this area down here. Technically, there's an argument to be made that you could get some sort of retest of this as a balance range, right? Break, retest, higher low, and the thesis lives on. But because of what we saw on the Friday session, I'm more so inclined to say that this wants to happen sooner rather than later without a retest of those potential lows. That's Pepsi, and last but not least is Walmart. Of course, Walmart is reporting earnings this week, so this trade needs to unfold ahead of earnings, and even ideally ahead of the day before earnings, right, as IV starts to get really funky on the options chain. But just a beautiful balance here. If we can take out the top, excuse me, let's jump on out to something like a 5-year time frame and see what we're dealing with. Yeah, this is an all-time high. This is an all-time high out of Walmart, looking for, I believe it's an all-time high. Let's actually go more than 5 years. Let's go 20. I just want to make sure I'm not lying to you. And yes, we, of course, have a new all-time high. All right, so good to go. Walmart all-time high is over the top of that balance at 166.27, and that is going to conclude today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. I hope to see you all in the pre-market prep, which is live every morning at 8:15 Eastern Time. We will have coffee and donuts up at the Penthouse on Tuesday for CPI. It's complimentary on me. With that said, I wish you a green trading week.